Hey everybody, Preston Brent here with our Trader User Group Weekly Roundup. This is for the trading week ending Feb 22, 2019. Well, we got March Madness coming up, and I'm just wondering, after watching that Duke University player blow through his Nike tennis shoe, if the S&P is going to do the same thing and just kind of blow through the track shoes that it's got on right now. This past week, the S&P is up 0.62%. Dow's up 0.57, Nasdaq's up 0.74, RUT's up about 1.4. So all markets had a gain this week. The VIX is down about 13, a little over 13.5%. It fell down to right at 13.51. And prior week it closed, I think, at 1491. So volatility's coming in. Sector performance wise, the best performing sector was materials, 2.78. And we just did a market analysis and sector rotation in our option masters, and we had talked about materials and industrials as well as giving us indications and clues as to where the economic cycle is. The worst performer for this week, by the way, is healthcare XLV. It was down 0.36%, 36 basis points. And the PE ratio right now is about 16 and a half. So it seems to be an average fair value right now for the markets, and it's down a little over 10% from where we stood at the highs this time 12 months ago. So we seem to have things lining up for us. I mean, the Dow this past week, it had its ninth straight weekly gain. It's up about 16% cumulative since we had these lows on the 26th of December intraday. And we've kind of finished a rare V pattern. It's all but complete, really, from a technical pattern perspective. I'll show that to you guys in a minute on the charts that we're looking at. But also, it's not only the Dow that's been up. All indexes are up, but it's also a global advance as well. We've seen the Shanghai up about 12.4%. It's capping its seventh weekly gain. The Nikkei ended a 6-week winning streak, but it's been up 6 of the past 7 weeks, and it's up about 12%. In the European Stoxx, the largest companies across Europe, it just finished its 7th week up in 8 weeks, up about 12.6%. So we've had a global advance here, primarily because a lot of the central banks have backed off their tougher monetary policy statements. And markets have, no doubt reacted very positively here in the U.S. I mean, the cumulative effect of these big moves across the U.S. indexes, from the Dow to the S&P to the Russell, Nasdaq, the cumulative effect has been an additional 5.1 trillion in wealth has accumulated to just U.S. investors or investors in U.S. markets. Just since the beginning of the year, or off the lows in December 26. Really amazing. Also, this euphoria is continuing with volatility. I mean, I've talked about the Dow up 9 straight weeks. Well, guess what? The VIX volatility, it's a measure of volatility, has fallen for 9 straight weeks. I'll show you that chart here in a minute. But it closed this past Friday at 13.51 from a Q4 peak on December 26th. At 36.2. So everything seems to be coming up rosy right now. Now, I was looking at some stats here, and typically you've heard of hard landings and soft landings in the economy, but if you haven't, most hard landings are typically characterized, especially here in the U.S., by the Feds raising rates faster and getting ahead of the markets, really faster than they should, and it causes the markets to actually fall hard, and then sometimes you're only running right into a recession. So you could probably say the Feds have purposely, in their bout to combat inflation, drive rates up really high, and that causes a hard landing. And in the history of bull markets, there's only been about 3 instances here in the U.S. where the Feds have actually generated a soft landing, and that was in 66, 84, and 95, and they did it all by reducing the rates towards the end of a business cycle rather than raising rates. Now we're in that exact same situation today. We've had this huge, robust run where, depending on which business channel you're watching, we're either in the 8th or 9th inning or overtime in a football game, where the business cycle, everyone is saying it's going to end. And yet the Feds we're sitting at interest rates that are still historically extremely low. Inflation is extremely low, and we're this late in a business cycle. We should not see it like this. And the reason why we do is because of the trillions, and let me underline that word trillions, of dollars of stimulus that have come into the markets since the 2008 debacle. Okay, I mean, it doesn't seem like, 11 years ago we had the huge move lower, a decade ago, 2008, 2009. He reaching the lows in March of 2009. Okay, and so we've been on this bull market tear since, and through March 9th, it'll be like the second longest bull market in history. And if we get through June 29th, it'll be the longest bull run in the history of the U.S. markets. And it's amazing since, like I said, just almost a decade ago, we had the worst economic depression since the Great Depression of 29. So these markets are reacting to the monetary policies of the central banks globally. And as we've seen in this V bottom off the lows on December 26th intraday on the futures market, we've had this huge sharp and a very rare pattern, a V pattern, without so much as a 3% pullback. It's just been phenomenal. And all of that was due to Jerome Powell reversing his monetary policy stance from hawkish to dovish. And now we've seen that echoed by Super Mario Draghi with the ECB. We've seen China and the People's Bank of China come out with more their version of stimulus, and we're off to the races again. But as you guys know, nothing goes straight up forever. And generally, the harder we fall, the faster we bounce higher, and then it just becomes this oscillator that just continues to get out of whack. And that's what happens when you put $4 trillion into the markets, because there's no place else for money to go, right? There's just no other place. And right now, we're seeing a lot of cash on the sidelines still by institutional investors. They're just a little bit leery of getting back in. But the higher the markets go, it creates this fear of missing out effect. You've probably heard the term FOMA, where more and more institutional investors and other cash is going to be forced from the sidelines to come in because they can't afford to be out in a big market run, because they've got to explain it to their investors as to why they didn't participate. And that creates and accelerates the run higher, which will further aggravate downside moves again when there's a rush to the single door exit by all the crazy mass herd. So that's kind of where we're sitting right now. Now, we've been playing the markets in our user group to the upside, okay? Don't get me wrong, but we are very, very cautious in this move. So what I've got on the screen here is a daily chart of the S&P 500 E-mini futures. And you can see, when I was referring to that V pattern, there it is right there, right? I mean, it's just, of course, I didn't draw it very well, but you guys get the idea. We've right back up to our prior pivot highs right there. In fact, right at the point when Power Ranger Powell came out on December 4th and said, well, we're on quantitative tightening is on autopilot, right? And the minute he said that, that was on that candle right there. Away we went. We started moving that V right there, okay? And then just a reflexive bounce here, and then we started back down. We were coming back down. Actually, we were probably going to take that low out. And then on January the 4th, right there, he came out and said, au contraire, I misspoke. I'm now going to be a dove. This white little angel dove, and we're going to be dovish in the markets. And then poof, off we went. And then it's not ironic that we came right back up to where we started, right? Maybe slightly higher, but that's about it. So that's what we've done. And now the markets, we're almost through Q4 earnings. Earnings are coming in better than expected, but keep in mind that the expectation bar was dropped dramatically. All right. It's like stepping over a bar that's on the ground. That's easy to do. And then quarter over quarter comparisons are going to get harder and harder as we move through the year. Now, we've got a lot of things that can happen in March. One, obviously, the upcoming trade tiff with China, and what's Trump going to do? What's Xi going to do? We both know that they need to get a deal done. So I think the best thing that most politicians like to do kick things down the road. So they'll probably get a temporary victory that can say, well, I'm not going to increase the tariffs. I'm going to leave them as they are. And China's going to buy a lot of stuff, or maybe he'll back off on all the tariffs, but I don't see that. But either way, it's going to cause a reaction in the markets. Okay. You can see here over this past week, we haven't really gone anywhere. We just kind of traded in a range. The risk of the bigger move is still to the downside. We may have an electric shock to the system and we move up here, but I think it's going to be met equally by another shock back down again, unless we get um, more from corporations on their forward guidance, but I'm not seeing that right now. So we're still seeing growth for 2019. It's just a lot slower growth, right? So that's kind of what we're looking at right here. And you can see this pattern here. Now, we're also the value area going back through this market map measures the volume at price, and then it takes the highest volume and puts a yellow bar on it. The value area is sitting at 27.14. So we're a little bit stretched just looking back on the value area going back to the middle of November. Okay. Now, if I step it back a little bit more, you can see I've got another market map and another value area that goes back through the summer of 2018. And you'll see there's two value areas. There's one established at 27.93, which we're slightly above right now at 27.95. And then there's a no man's land in here. And then there's another value area sitting at 29.07. So getting through this 2800 value area it's going to take some work. And I think the only way we can do it, as I was telling our members, is we've got to get a really good positive surprise on the China deal. So we got that value area sitting right at that level right there. Okay. And if I were to extend it over, that's kind of exactly where we're sitting right now. And then you can see sitting here, poking up above, right here are the key pivot points. So for us to get enough escape velocity to get out of there, we need some kind of elixir that's going to, just kick us in the butt and move us up in that area. And that's going to be this initial shock with the China deal. If it is better than expected, we're going to run up there. I'm not sure how the markets are going to react if they come to some temporary agreement that allows us to postpone 2 months the tariff hikes. So we could get a deal that says we've agreed in principle on the trade. So I'm not going to hike the rates anymore. Or I'm not going to hike the tariffs anymore. We're going to leave the current ones in until we finalize the IP intellectual property stuff, because they're not going to get that done by this coming March 1st. Okay. So that could cause the markets to sell off a little bit in anticipation of this, because a lot of this move, probably from this area here upwards, is anticipation of a done deal. It seems like everybody, and I think the markets are a little bit overly optimistic on that. If Trump were to take the tariffs off, they were to disappear, and then say we're going to work on the IP over the next couple of months, but I'm going to, in good faith, take the tariffs off. But there, I can always put them back on in 2 months. That's another option for them. And in that case, and we'll probably have the nutritional value to get up above all of these prior pivot highs right there, and then we'll come up and start challenging our all-time high at 29.47, taking out that 2900 key area right there, which is near where the next value area is. Okay. And then if nothing happens, then we're going to come back down and it's going to fall really hard. And it's probably going to force the Feds to back off on any talk of future rate hikes and then talk about possible rate cuts. Okay. So by one token, if they get the China deal done, our markets are going to take off, depending on what done means. All right. Our markets can take off. We're going to see Europe take off. China's going to take off. Then the Feds are going to be put in a position in another 90 days or so of looking at rate hikes again, because if we see signs of inflation coming back in, we can see that. So there are a lot of options moving this market right now. And that is why a lot of big money is on the sidelines. They want to see how this plays out before they start committing capital. But I do believe we're a bit stretched here in this market. And if I were to blow it up just a little bit more so that you guys can see here, you can see the basics since the February 15th. Over the past week, we haven't gone anywhere, right? These bars are fairly flat. We've just been waiting for this deal. Is there a deal or is there no deal? And what's going to happen? And what's the definition of it? Okay. So that's a little bit about where we're sitting. Now, on a 50 EMA and 200 EMA right here. Okay, these are EMAs, not simple moving averages. We're looking at possibly we're close to getting across back up again, which would be really good. It'd be very healthy for the markets. Okay. Both of them have got an upward trajectory, so we're going to see how this thing is going to shake itself out. They do provide support for us underneath. All right. Now, if I were to, let me just take it in a little bit of a tighter time frame, and I'm going to throw some Bollinger Bands on here. Now, let me just move to another screen and another chart. Let's do this one right here. So now what you're looking at is a 2-hour chart, 120-minute chart of the same E-mini futures with Bollinger Bands, but I've thrown 3 on there. So there's 3 standard deep. The red is 3, purple is 2, which is a standard Bollinger Band chart. And then blue is a 1 standard deep around the center line, which is a 20 EMA. Okay. So you can see here what we have is, I mean, if you look at this, it's really amazing because we have a series of constriction expansions, which is what you normally expect with a Bollinger Band. It constricts, then it expands. It constricts, then it expands. It constricts, then it expands, right? And you see these things and they occur with a regular basis. So it's a good way and a good tool. Again, this is a 2-hour chart using a 3 Bollinger Band rather than just the normal Bollinger Band, right? It gives you a good idea to see when you get these constrictions in here like this or like this clearly. And the longer the constriction, the more the expansion. And it's a good way to set up particular options trades because once you've got a contraction, it leads to expansion, and expansion leads to slowly contraction again, and then it's a cycle. Now, these Bollinger Bands clearly have been going up. So most of the expansion has been to the upside, right? I mean, those are all upside. And there's been only one downside right here. And this goes all the way back to the beginning of February. So it's a 2-hour chart, or end of January. So it goes back about 3 weeks. And we've had 4 contractions that have led to expansions to the upside, and just 1 that led to an expansion to the downside, right? Normally you get a little bit better mix than this, but this just shows the bullish nature of the market. And using something like this is also a helpful guide in helping you kind of figure out, what's your bias in the trade, and if you're in a expansion phase here, whether the phase is moving up or moving down, you can use the red lines, which is a 3 standard deep move that would suggest once it gets there, it's going to pull back just a little bit. So it's a good timing indicator as well. Now, another chart that we like to use, I don't show it here too much in our weekly roundup, but I do in our user group on our weekly market watch. I talk about the Ichimoku, okay? And on the Ichimoku here, you can see on this daily chart, we had a buy signal back over here right around the 11th of January. And technically, we had a buy signal even earlier than that, if you wanted, back over here in December the 28th. Okay, we had a little bit of a pullback, but set up a buy signal with this red line being kind of a stop out point on a daily chart. And you can see where the market has just kind of followed this line up and a closing red line. I mean, a closing candle below the red line, and there has been none. So we've been in this bullish mode all the way up here. Now, For those of you that are interested in learning a lot more about the Ichimoku, you can sign up for our option masters, or join our user group and learn more about it, because it really is a really cool chart indicator overlaid on a candlestick chart that gives you some good clues here. Also, the lagging indicators above price, so that says we're still fairly, we're going to err to the bullish side. You can see the cloud here is red underneath, but over here in the future it's green, so that still indicates we got a bullish move. And you can see the MACD is relatively flat, so any pullback here is still likely to be bought. And there are other things on here that suggest some things for us, and for our members, we'll take a look at it this Sunday evening. And if we were to break this down also like we did the Bollinger Band and go into a 2-hour chart, you can see here how this green cloud has provided support for the market action up. And we're still in a bullish mode right here on this 2-hour chart. Now in the future, it's showing, notice here, we're seeing some signs of red. So we've got green and we've got red, but notice the width of the red here in the cloud, the future cloud. So that indicates that we're going to be in a choppy mode, in kind of a consolidation mode. Some slight downside could be coming. And for our members, we'll go into more detail on this on our weekly market watch this Sunday. But it's a really good indicator to add to your arsenal, because it can confirm and give you a heads up sometimes where a typical candle chart is just not going to do service, right? It's not going to take care of it like it should. So if we move back to our chart here with our market maps on here, this is kind of where we're sitting. And of course, if we look at the Dow with 9 straight weeks, you can see here, notice here on Friday, we've got the 50 EMA, and let me blow it up a little bit so you can see it, right? You've got the 50 EMA just now poking its head above the 200 EMA, right? On Friday, it was official for the EMA, not the simple, but the exponential moving average of the 50 over the 200. That is starting to light the green light again for the markets. And this also tends to serve wherever you have a cross in the 50 and the 200, because of the lagging nature of the 50 and the 200 EMA, especially the cross, it tends to serve as a resistance or a support point. In this case, a support point, which puts us right around 24,870 area. Okay, and you can see where the 200 EMA provided really good support here for the Dow. And now with the 50 EMA crossing, the value area here going back 90 days is sitting at 25,317. So we've got some solid support here underneath. So we're still in a bull mode, guys. And we're going to have a lot of fun in 2019. 2018, we had a good year. And in our secret trader for our members, in this 2019 is probably going to be even better. Remember, when the markets start to move down, they're going to move very fast. And we have not really had technically a correction to this V wave here. You can see even on the Dow, it's just down and it's up. We're going to have, and we can anticipate anywhere from a 3 to a 5% pullback in the next 30 to 60 days. Doesn't mean it's going to happen, but the odds favor it, because we generally, a V pattern like this, that actually is completed, meaning we've come right back up to the formation of the V, and that was caused by Power Ranger Powell, as I said. Okay, chart pattern looks exactly the same. December the 4th, right here on this candlestick, Powell came out and said autopilot for quantitative tightening, and away we went. And then we came up, and then in early January, when we started pulling back, we were going to come back here and take out these 2018 lows and this pullback here. And then Powell came out and said, au contraire, I'm going, super dovish, and then away we went. All right. So a complete 180, I mean, literally a 180 shift in monetary policy, just unbelievable. And then all the other Fed governors came in and supported Powell. So that's what gave us the V pattern. But we will have a 3 to 5% pullback, more in a profit-taking mode. I don't know what's going to trigger it, but remember, March Madness is coming up. So we got the China trade deal at the beginning of March to kick things off. We got the Brexit at the end of March. And we've got just a number of things going on across Europe and in China. So let's watch very closely to see how this thing shakes itself out. So these are the key indexes that I'm playing and I'm watching here. Let's look at the VIX. If we look at volatility, because I did mention it earlier, you can see here in the volatility, right now we're back in the green zone right here. All right. We left the green going north right at the beginning of October, and then the markets just came down. This period here of being in the yellow and then the rose and the red area for volatility, these are levels that we look at different option strategies that make more sense in different color patterns. Right here, as we move up like this into these levels, you want to look at different option strategies. And this is typical to move up and stay up this long when the markets have such a cataclysmic event that we had in Q4. Remember, December was the worst December we had since 1931. Right? It's really bad. And October was the worst October we had since 2008. So Q4, when you put it all together, is really horrible. And you can see the big movement in volatility. And we stayed outside the green for a very long period of time. And then we finally moved back into the green this week. And now we're at the higher end of the green, which is around the 15, around the 15 area. Okay, separating the green from the yellow. All right, so let's kind of see the value area going all the way back to the middle of November for volatility, sitting around 1995. Okay, and if we look at where most of the volume took place, going back from July to leading up to October, it was around 1237. All right, so that's kind of where we're going to settle back into, right down here around 1237. Should the market continue to move higher? And if we don't, then we're prone to the move here. For our members, as the 50 crosses the 200, we're going to jump back into our shorting strategy on VXXB. We've got a great way to play volatility, and we've got rules that pertain to that. So we're going to be looking at that, if or when the markets are conducive for it. One other thing about the volatility is if we look at term structure, if we look at the front month term structure, we're in the green. That means the March vol futures are higher than VIX. That is where the markets are not feeling a lot of pressure right now. We're almost right at the value area of a minus 1.18, which means the March vol is 1.18 higher than the VIX, right? It finished at 1.64. Minus 1.64. So, the skew is starting to steepen just a little bit. If we look at the back month, which is March and April, look at this one. So the difference between March and April is even higher. So the skew is showing a little bit more of a steepness here. The further out in time we go, because we're in the green here, and being in the green here is good for VXXB, the strategies that we use using the new VXXB ETN. So these are some things that we're watching very closely. If we look at Treasuries, really moved up on Friday, which meant interest rates are staying in this level right here, because Treasuries interest rates are not going up right now. They're staying down, pressured down because of the Feds. If we get some, and that means there's still a lot of money in the bond market right now. You can see the value area here in bonds is at 145 and 15 ticks. So we're slightly north of the value area of where money is spent most of the time in the bond market. If we look at the 10-year interest rates, right, you'll see they are down. They're down relatively low here. All right, and if we look at this, you can see these 10-year rates are well below the value area. So this suggests the rates can come up just a little bit next week. You can see these exhaustion bars down here with this move lower in interest rates, almost down to a level that I was calling for, which is around 2.5, which is where I think we may end up going. Okay. So that's a little bit about where these things are sitting right now. And then, of course, if we look at currencies, we look at the pound. As I've been saying all along with the British pound, it was moving up right here even though with all the Brexit problems, on the idea that they were going to delay everything. And then there was a profit taking mode here. I think the pound is going to be, I'm stepping out of the pound until we get through this Brexit. It's going to be fairly choppy at this level here. And then, of course, we got the US dollar, which even though we pull back a little bit, you can see we're almost right at a value area. So we're in this range here, this no trade range in the US dollar. So I do believe that we're going to stay in an overall choppy range of the US dollar near term. For our members, I'll go through a little bit more strategy on where I think the currencies are going to go and where I think the opportunities are going to present themselves. If we look at oil, now we've had some really great calls in the oil market. Up in this area here, I was talking about shorting oil, and some of our members took the trade, made 20, 30,000 per contract on this move lower. And then, of course, if we look here, we had this level here, and then I was calling for a longer play here in the oil market, right? And we had this move here. I was calling for a longer oil play. You can see here some of these exhaustion bars right here, and then we just came right back down here with a couple of just an over exuberance to the downside, right? And then I was talking about mid 50s down in this area here, and that's kind of where we've moved. We've overshot my level just a little bit. We're coming up to a natural resistance point of 0.38 fib level. I think the upside movement of oil is going to be relatively hard here. We can do it, but I think longer term oil is going to come back down again. And then, of course, same thing with gasoline, nat gas. We've had some great trades in that for our members, and I won't go through that here with you guys, but that's kind of where we're sitting right now with the energy market. And then, of course, metals. You guys know I've been a bull in gold for a little bit of time now. Actually, back down here in September, October timeframe, I was suggesting selling puts, bull put spreads underneath the gold market because we had really a pretty good, and it was really kind of partially defined at that time, but it was becoming more defined, right? I mean, we had this right in this area here, we started to have this rounded bottom, right? So in this area right here, I said that seemed enough for me. And we were getting across to the high side right here. And I just said selling puts underneath the market. And if you wanted to limit the risk, buying a put and doing it as a bull put spread in the gold futures market made sense. And then we continued on our path and breaking out up in here. I said you could even look at now we're starting to form our cup and handle. And then we had this, this pullback right here. And then we broke out of this level right here. And now we did a retest and we broke out again, right? So I think big money, and this is a value area sitting right in that area there. So we're probably going to chop around here and then probably have another breakout here. But we've extended it pretty good. So we're going to end up chopping around a bit. But the better part of the entry of the trade was down in this area down here, which is what I was suggesting to our members. And in fact, I even was giving you guys here in this free weekly roundup the same kind of technical advice. I was a little bit more specific with our members, but for you guys, I was just giving you some ideas and thoughts on ways that you could make money in the gold market, at least in the near term. Okay, so that's kind of where gold is sitting right now. Same thing with silver, although silver, it's a little bit more choppy, but and the pattern is not as pretty, but we had the handle move up, we had a false breakout, we came down, and we're just in this choppy mode right now. Okay, so that's kind of where we're sitting. And then, of course, we got some opportunities in the ag market. Meats, we got some charts here that we're following. Also on the countries, you can see this past week, all the countries were in the green, at least on Friday. And we've been playing some things in Latin American markets and some other markets as well, because there's just a lot of opportunity there in emerging markets. Because if we look at emerging markets right here, you can see where we are off the 2018 lows, 2018 close. Here's a 2019 high, similar to the 2019 low, which was right in this area here. So emerging markets and the Chinese markets, if this Chinese trade deal gets done, I think those will outperform the S&P because there's been more money coming into the S&P. Everybody loves the US markets right now. But I think if the China trade deal gets done, you've seen a tremendous lag effect in emerging markets and the Chinese markets. And so FXI would be an interesting play, or ASHR would be an interesting play in the Chinese markets. All right, everybody, that's kind of where we are right now. Members, I will see you this Sunday night. If you're not a member, I highly encourage you to come in. We're having a good time. I think 2019 will give us even more opportunities than 2018. Take care, folks. I'll chat with you guys later.